All right. So this will be the fourth and final part for the exam review. We've got this problem. Due to a sluggish economy, Bi-Wheels Company has experienced some difficulty selling its bicycles. The following data relate to 2006, and they ask us to compute Bi-Wheels break-even point in both units and dollars. So in units, it would be the 100 selling price minus the 60, that's 100, minus the 60 variable cost gives us a unit contribution margin of 40. We take the 400,000 fixed cost, divide it by 40. They would need to sell 10,000 bicycles to break even. That's units. Dollars, we would take the 40 divided by 100, and that would give us a 40% contribution margin ratio. And so then we take the 400,000 in fixed cost divided by 0.4. And we would need 1 million in sales dollars, right? So that's part one. Then part two says the manager believes that a $40,000 increase in advertising would result in $120,000 increase in annual sales. If the manager is right, what will be the effect of income or loss? Okay, so a couple of different ways to tackle this. My favorite way would be to take the 120,000 times the 40% contribution margin ratio. That would be 48,000. Subtract off the 40,000 increase in advertising. So that would increase our profitability or decrease our loss by $8,000. So going back to the original data, the vice president's sales is certain that a 10% reduction in price in combination with a 30% increase in advertising will increase sales by 50%. What would this strategy have on income or loss? The best way to do this one is to just do a pro forma income statement like we have at the top there. And so we would take sales would increase by 50%. So 9,000, 1.5 times would be 13,500 times 10% would be $90. 10% less 100 would be 90. Would be 1,215,000. We would have new variable costs of 13,500 times 60. Would be 810,000. So we would have 405,000 contribution margin. Our fixed costs stay the same, 400,000. And now at least we are profitable by $5,000. So that looks like a, oh, what do we say? We forgot the 30% increase in advertising. So now we're at $25,000 loss. So we're better than 40,000, but still not in the black on that. Okay, the next one. A high-low method, calculate the unit variable and monthly fixed costs. So this time we've got the costs and the things backward from what we normally do. Our high volume is 1840 with 62,370. The associated cost, and the low volume is 1340, giving us a difference of 500. The cost associated with 1340 is 5320, and so 12,050 is $24.10. That's our variable cost. We plug that back into either one of these, 62,370 minus 2410 times 1840. $62,370 minus 44,344 is 18,026, and that is our fixed cost using the high-low method. All right, back to some multiple choice. Management accounting information typically includes the cost of producing a profit. Actually, D is all of those are right. Percentage of units produced. Yeah, all of those are management accounting. Rules for measurement and reporting of management accounting. B, do not need to follow GAAP, but must meet the cost-benefit test. Right. Blank is a detailed planning, engineering, testing products or services or process. That would be design. Blank describes the flow of goods and services and information for the purchase of materials delivery. That's supply chain. Sustainability is the financial, social, and environmental goals. Number 6, cost assignment. Cost assignment associates accumulated costs with certain cost objects. When cost can be traced to a particular object in an economically feasible manner, it is a direct cost. A, which of the following fixed costs with respect to units produced in a factory? A monthly rent payment for the building, definitely. Electricity could or may not be. Same with utilities, may or may not be. If each motorcycle requires a belt that costs $20 and 2,000 motorcycles are produced for the month, the total cost for belts would be considered a direct fixed cost. Number 10 here, Atlas Manufacturing produces a unique valve and has the capacity to produce 50,000 annually. Currently, Atlas produces 40,000 valves and is thinking of increasing production to 45,000. What is the most likely behavior of total manufacturing costs and unit manufacturing costs given this change? Total manufacturing costs will increase, right? Because we've got the increase in variable cost, and unit will stay the same only if they're all variable costs. So there's no fixed cost. Total manufacturing costs will increase and manufacturing costs will decrease. That's the most likely because you're spreading the fixed costs over more units. A, number 11, Campus Apparel is a clothing maker. Unit costs associated with one of its products is as follows. What are the period costs associated with DCT 111? So the administrative salaries, sales commissions, even though it's variable, it is a period cost. All selling and administrative costs are period costs. Let's see, fixed manufacturing overhead is a period cost. Variable manufacturing is not direct. Let's see, no, fixed manufacturing overhead is not. All right, that's a product cost. So just these two, the 13, the 17, so 30. Be there. And then finally on this page, the contribution per margin per unit equals the selling price minus variable cost per unit. So C. The contribution income statement highlights variable and fixed costs. Right. Family Furniture sells a table for $1,000. Its fixed costs are $35,000, while its variable costs are $700. It currently plans to sell 180 tables this month. What is the budgeted operating income? So you have 180 times 1,000 minus 700 is 300. $54,000 minus the 35,000 fixed costs would be 19,000. So Blister Company operates a contribution margin of 40% and currently has fixed costs of $510,000. Next year sales are projected to be $3,100,000. An advertising campaign is being evaluated that costs an additional $110,000. How much would sales have to increase to justify the additional expenditure? So what's interesting here is it does not matter what the current fixed costs are, and it does not matter what the net sales or the projected sales are. What you need to know is this 110,000 divided by that. So that's the additional fixed cost divided by the 40% contribution margin. So you need 275,000 more additional sales in order to justify the advertising campaign. Okay, blank is the process of assigning indirect costs. That's cost allocation. Which of the following differentiates job costing from process costing? And so A is backwards. Process costings was each unit's output is identical, and job costing, unique products not produced in batches. That would be that one. So C. And then finally, 18, Franklin Manufacturing uses machine hours as the only overhead cost allocation base, so they have a single plant-wide rate. The estimated manufacturing costs are $220,000. Estimated machine hours are $25,000. So we've got 220,000 divided by 25,000. Okay, the actual manufacturing costs of 360 machine hours or 40. For this question, the manufacturing overhead rate, that last sentence we don't need. And so 220 divided by 25,000 be $8.80. D. Okay. Which of the following items is debited to the work in process account? Allocated manufacturing overhead is. That is credited. Completed goods transferred out is credited. Accumulated depreciation on fixed assets is debited to manufacturing overhead control, and accounts receivable has nothing to do with work in process. So A is the only one that makes any sense there. River Falls Manufacturing uses a normal cost system and had the following data available for 2020. The ending balance of finished goods inventory was, we have beginning inventory of 56,000. Finished goods at the beginning. We have our cost of goods manufactured, 289,000. This is our goods available for sale. Then we have our cost of goods sold is 251,000. And so our ending finished goods inventory is 94,000. See? Number 21. We need a schedule of cost of goods manufactured and cost of goods sold. Okay, so we start with the direct materials. Oh, that's given to us, direct materials use. So we'll start with beginning work in process is 140,400. Then we add our direct materials is 420,000. Our direct labor, direct manufacturing labor, 480,000. Now we need our overhead, and we can put these down here individually, or we can add these all up. So I'm going to add these all up and add it as manufacturing overhead. So we've got 84,000 for the indirect materials, indirect manufacturing labor of 186 here. Property taxes, 28,800. That salesperson, that's a selling administrative expense. We don't use that. Depreciation on manufacturing equipment, 264,000. That Depreciation and office equipment, we don't use that. Miscellaneous plant overhead, 135. We use that. Plant utilities, 92,400. We use that. General office expense, we do not use. And marketing and distribution, we do not use. So we add these up. I get 790,200. Add those all up. We get 1,830,200. This is our total manufacturing costs. We subtract off the ending work in process inventory of 171,000. And so our cost of goods manufactured is 1,659,200. And then we're asked to do cost of goods sold. So our beginning finished goods inventory is 540,000. Then we add our cost of goods manufactured, 1,659,200. Add those together. 2,199,200. This is our goods available for sale. Subtract off our ending ending finished goods inventory, 510,000. And this is our cost of goods sold. All right. During 2020, the Get There Corporation incurred manufacturing expenses of 200,000 to produce 40,000 finished units. It was determined that 35,000 were sold by the end of November, while 5,000 units remained in inventory. Storage cost for December is 5 cents per unit. What is the cost of producing one unit? So that's just A is 200,000 divided by 40,000, and that's going to be 5. B, what will be the cost of goods sold? 35,000 times 5 equals 175,000. And then C, what is the cost incurred for storing the inventory? So that's 5,000 times 0.5, 50 cents is 2,500. Query Company sells pillows for $25 each. The manufacturing cost, all variable, is $10 per pillow. The company is planning on renting an exhibition booth for display and selling purposes. The annual Crafts and Arts Convention, the convention coordinator allows 3 options for each participating company. They are paying a fixed booth fee of $5,010 or paying $4,000 fee plus 10% of revenue, or paying 20% of revenue made at the convention. Compute the break even of pillows in each option. So in A, so on A1 is $5,010 divided by $15, the selling price of 25 minus the 10 variable cost is 15. They need to sell 334 pillows. With B, the fixed cost is now 4,000, but our contribution margin goes down by 10% of the revenue, which is 10% of 25 is 250. So instead of 15, we would have 1250. This is A2. And they would need to sell 320 pillows under that arrangement. And then A3 would be paying 20% of revenue. And so the break even is 0, right? Because there's no fixed cost. So if we don't sell anything, we don't have any. Right? And so B asks us which one should we use if we're going to sell 800 pillows. So we take the 800 times the contribution margin of 15, should be 12,000, I believe. Yeah, 12,000 minus the fixed cost of 5010 would be $6,990 if we take option 1. For B2, it would be 1250 times 800. Which would be 10,000 minus the 4,000 fee. So $6,000. So we're better off B1 over B2, but we still have B3, which would be 20% of revenue would be $5. So our contribution margin would be $10. 8,000 times 10, 800 times 10 is 8,000 minus 0 fixed cost is 8,000. So we are better off taking the the variable amount with that. And last one for the review here. Chief Manufacturing is a small textile manufacturing using machine hours as a single indirect cost rate to allocate manufacturing overhead to various jobs contracted during the year. The following estimates are provided for the coming year for the company and for Somerset High School Olympiad jacket job. Okay. For chief manufacturer, determine the overhead rate. So they use machine hours, and so the manufacturing overhead is $20,000 divided by 40,000 machine hours would be 50 cents per machine hour. Okay. Determine the amount of manufacturing overhead allocated to the Somerset High School jobs. So they're going to have 800. So this is B is 800 times would be $400. And to determine the total manufacturing costs, so that's going to be 600 in direct materials, direct labor is 200, and manufacturing overhead we just calculated at 400, so $1,200 is the total cost for the Somerset High School jacket job. All right, so that concludes the review. Again, I'll be around. Email me if you have any questions, and good luck on the exam Monday.